Okay, so we look at the bad dates and provisions for doubtful debts. So one thing that you have to be aware is that, you know, when you sell as a company to the customers, you can either sell uh, by cash or you can sell on credit. So the times when you sell on credit, those times when you sell on credit, and those people to whom you've sold to, um, they have failed to pay back the money that they owe you for different reasons. It could be that maybe the person, take for instance, the person has died and there was no agreement anywhere that you would recover the money from the third party. And for that reason, you may not be able to recover the money. So that amount that you have failed to recover for various reasons is what we call the bad debt. Is that clear? So bad debt is an irrecoverable amount, right? Bad debt. An irrecoverable amount, the amount that you cannot recover, from your debtors. The people that owe you are called the debtors. Then the money that they owe you is called the accounts receivable. Okay. Now, about the provisions for doubtful debt, or the provision for doubtful debt. The provision for doubtful debt is also called an allowance. An allowance, for receivables, right? An allowance for receivables. That's the other name. So in case you come in an exam, you find this one, should not be confused. Understand we are referring to the same thing. So what do we mean by allowance for receivables or the provision for doubtful debt? I have already indicated that it is not always that when you sell on credit to the customers, then they will all give you the amount that they owe you. To some degree, others may not be able to settle the debt and you may not be able to recover some amount. That knowledge is very important to you as an accountant. So you have that knowledge, then it is prudent for you to ensure that every time you sell, then you do not, overestimate the accounts receivable. That is to say, you ensure that you give a provision, some element of doubt or some estimation of a doubt that these people may not be able to recover all the money. So you leave a certain percentage, which is some element of doubt on the receivables. So that estimate that you just estimate, you say, okay, I think out of all this total amount that we or that the debtors owe us, I think maybe 10% or 5% thereof, we may not be able to recover it. That provision is what you call the provision for doubtful debt. You're right? Are you fine now? Okay. So that's what the two terms mean, and that's how different they are. Bad debt, written off, it has been incurred. You are sure you're not going to recover that money. Then provision for doubtful debt is just, the estimation that you put that approximately such an amount we may not be able to recover. Now, the entries are summarized as follows. When the debt is written off, you write off the debt, then you credit the debtor's account and debit the bad debt account. That is very important for you to understand. So the journal entry, the entries are, you credit the debtor's account, which is the accounts receivable, okay? The receivables account. And then you debit the bad debt account. Okay, if you are to debit the bad debt account, it means you will have to credit the profit and loss account in that way. And at the end of the period, you'll have to credit the bad debts account and debit the income statement. These are some of the entries that you make. Now, let's see what happens. Okay, sometimes you are able to recover the debt. This is very important, the bad debt. There are those times when you had estimated and written off some bad debt, right? Thinking that we are not going to recover this money. But all over a sudden, maybe those people that you counted that they are not going to give you the money, then they decide to give you the money, right? If they give you the money, then that is called the bad debt recovered. So it means that you have recovered the bad debt. Okay, so a bad debt recovered arises when a debtor pays some or all of the amount owed after the amount was written off as a bad debt. That's when the bad debt recovered comes in. So you have to make sure that you understand the bad debt recovered comes in when the debtors pay back the money. That's after you had already written them off as bad debtors. Okay. Maybe the entries, about the entries, when the amount is received, you debit the cash book. Okay, you debit the cash book because it's a receipt from the debtors. Debit the cash book, and then you credit the bad debt recovered account. Okay, the bad debt recovered account has to be debited, or alternatively, you can debit the cash book and credit the data the data, that is debit the data and the credit the bad debt recovered, which is just the same thing. It's a reference of the words. In other words, just debit the cash book and the credit the bad debt recovered account. Then at the end of the year, you can debit the bad debt recovered account and credit the income statement or the profit and loss account. To be specific, you can credit the bad debt account. Okay. An example will do better. Let's look at an example. Yeah, there is this sole trader who sells goods on credit. Now pay attention to the reading of the question. He offers customers a cash discount of 2% if accounts are paid within 30 days. Okay, so the financial year ends on 31st December. So he sold goods worth $400 on credit to Bavans stores on 1st February, let's say 2022. So the account was settled by check on 28 February 2022. On this date, Bavans stores purchased further goods, $150 on credit. Yeah. So after attempts to recover the amount due, he wrote off Bavans store's account as what? As bad debt on 3rd December 2022. Okay. After some months, he has just decided to write off the person as bad debt. Okay. Yeah. Now, he receives a check from Bavans stores for $150 on 31st October 2023. You get. So after you have written someone in 2022 December as bad debtors, then 2023 October, after 1 year, they decided to bring back that money. Okay. So during the year ended 31st December 2023, you wrote off the bad debts totaling to 820. Now, what are you required of doing? It is to write up the following accounts in his ledgers for each of the years ended 31st December 2022 and 2023. Yeah, that is in Bavans Stores account, the bad debts account and bad debt recovered account. So we need two accounts. We have to show entries in the bad debt account and the bad debt recovered account.
Okay.
Any question?
Yes.
So this is how you have a question?
Yes.
Yes.
So is it required to put both of them?
Yes, you are supposed to show all of them. You are supposed to indicate all of them. This is the solution that I'm presenting for you now.
Okay.
Yes. So this is how it is done. Okay. So it is said that number one, we are showing in Bavans Store's account. Bavans store, we sold to him, right? We sold to Bavans Store's account the goods worth $400, isn't it? That's what the question read. So if you sold to him in Bavans' account or his ledger account, the sales ledger, you will debit his account with 400 goods, $400 worth of goods, and when you record the $400, you are indicating that this person received the goods, right? He received the goods. You sold to him the goods worth $400. So that's why you debit his account $400. That is on 1st of February. Okay. Then on the 20th of February, what happens in his account? Okay. Let's read the question. What happens afterward? Wanted to follow nicely. We sold to him the goods worth 400 on credit. Okay. Yeah. Then the account was settled by check on 28 February, meaning he paid, right? That's what it means to settle. He settled the account 2022. On this date, his stores purchased further goods. Understand? So after settling the account by check, that's by bank. Okay. So his bank account, in short, paid, right? When you are settling the account, it means you are clearing the debt. So he settled the account. So his bank account, he paid using the bank account. It is said that he paid by check. So that's why we have to credit the account. Now, what is said is that there was a discount. Okay. He paid, but there was a discount in the question of 2%. If he paid within 30 days, and this person paid within 30 days. Okay, if you take from the time he got the date up to the time that he settled, it's just within 30 days. So we have to calculate the 2% discount on $400. So what is 2% of $400? So just say 2% times 400.
Yes.
How much is it?
I don't. 2% times 200. Eight.
It is 8. So there was a discount of what? Of 8. That we should deduct from the total amount that you're supposed to pay. So you're supposed to pay 400. We less the discount of 8. The difference, 392, is what we record. Is that clear?
Yes.
Just the same way how we used to do it when during the cash book. You know, how do you record in the cash book? Yeah. So $8 is the discount that you record. So this is how we record. Okay. Have you seen that the bank account, his bank account, this person has paid by this amount, the discount is 8. Is that clear?
Yes.
Then at the same time, it is said that in December, this person purchased other goods worth 150 after settling the account. Okay, he settled the account. But again, he purchased the other goods worth 150. But it is said that after purchasing these goods, this person, you know, he was written off. His account was written off as bad debt. He didn't. When concluding the year, they wrote the account off as bad debt.
Okay.
150. So there is this 150 that was written off as bad debt. So you indicate it on the credit side of this person's account. Okay. And then you balance off the account. Obviously, balancing off the account is not a problem with you. Just balance off the account. You sum both sides, you know those things. Sum both sides. But this account, you see that when you sum both on the credit and debit, it's just equal. So there is no need of saying balance brought down, balance carried down, because the account closes itself without any balance remaining. Okay.
Okay.
Now, how do you show this in the bad debt account? Because we are trying to show the writings in this person who was receiving. Now, how do you indicate in the bad debt account? This is what you do. Okay, in the bad debt account. The bad debt account for who? For this one who is selling, isn't it? The bad debt account belongs to the business now that is selling, not to the receiving person, not the Bavan stores account. It belongs to us. So every time we write off a bad debt, we debit our bad debt account. Okay. Once we write off a bad debt, we have to debit our bad debt account, of course, with the details of the person who owes us. Okay. So the Baban's account is the details that we're going to use. Then the amount that we have written as bad debt is what we indicate, of course, on the debit side of the account. Now, we are writing for each day. So this is just for 2022, like for 1 year. Okay. If you want, you don't have to put them together. You may not have to put them together. I mean, in the same account. Have you seen what I mean? Like you can break them down for 2023, you write it separately and you close it here where I have closed it. You've seen this line that I've drawn. Then again, you write the other one, you say 2023, you indicate what happens because you're not bringing down anything afterwards. Okay.
Okay.
Okay. So now, so you balance off the account, of course. So when you debit, I said the entries are you debit the bad debt account, or then you credit the what? You credit when you debit the bad debt account, the details that you use are the Bavan's account, which is the account, the person who owes or the company that owes us. Then you record on the credit side of the very account the income statement. That is to indicate that we are going to, when you balance of this account, you're going to, this money is going to the income statement. Remember, bad debt is an expense, isn't it?
Yes.
We said that bad debt is an expense and all expenses are debited in the income statement. So what we mean, the reason why we have put this on the credit side, we are indicating that according to the rule of double entry, it shall receive on the other side. Okay? It is going to receive. That is what you do. So in short, you just record this side. After recording, you sum both sides, Then this one, look at, this is the last day of the month, the 1st of December, and you record the income statement. It's more like the balance carried down, but you don't write balance carried down. Last day of the month, and you record that this is going where? To the income statement. You're following? It is going to the income statement. Then when we come to the 2023 now, what happens? 2023, the total bad debt that was written off in 2023 was how much? It is said that it was 820, isn't it? 2023, right? Then you record both sides, you add both sides, then you balance off the account. When you balance it off, this 820 shall go where? It goes in the income statement again.
Yes.
Yes, that's for 2023. So that's how you do it. Even if you had the details maybe for 2024 again, you could have done the same 2020, yeah, whatever the year is, you could have just been doing that again and again. Okay. So just get it that the bad debt that has been written off, you debit the account, of course, the account, that's the bad debt account, you debit. Then you record on each side, on the credit side, the income statement, showing that the income statement, when you complete the double entry, it shall receive, right? Shall be debited. That's why I put it on the credit side like this. Okay. Now, bad debt recovered account. How do you show? So I've shown you how to record in the other person, the receiving account, in the bad debt account, and also I'm showing you how to record in the bad debt recovered account, the bad debt recovered. How much bad debt did we recover? Because this person settled that 150. Remember, Baban settled the account, isn't it? So if the person has settled the account, you debit the bad debt recovered account, of course, with the details of the income statement, right? Showing that this income statement gave us. You are crediting the income statement. You're following? Because when you wrote the bad debt, remember, when you wrote the bad debt, you had to credit the income, you had to debit the income statement, isn't it? The income statement was debited. You're following? The income statement was debited. Now, this time around, we are showing that we are crediting the income statement. Don't be confused. It means that for this amount, for this account to go on the debit side of bad debt recovered account, we are asking ourselves, okay, the bad debt recovered account received, right? That's why you're debiting it, isn't it? It received. Then the question is that from where, from which account? It received from the income statement, isn't it? The question is, if you debit the bad debt recovered account, it means that it received. Then the question is, it received from where, from which account? Are you following? Hello? Salepi, are you there?
Yes, I am.
Yeah. So it means that this account received from which account? From the income statement. So the income statement was credited. Okay, so this is what we are trying to do. So it's more like the bad debt account is a reversal of the bad debt recovered account. See what happens. Then, of course, you have to balance off the account. When you balance it off, you see the credit part of it. And this amount that you write, it goes directly in the bank. For who? It goes in the bank for Bhavan's account. Okay? Yeah. So basically, this is what happens. Now, do you have any questions?
No, I don't think.
Okay. So maybe the question that you have to ask yourself is, when you look at the provision for doubt of debt, you have to think of the possible methods that we can use to reduce the possibility of us having a bad debt. And one of them is to introduce the discounts for the early settlements. Right. If people are able to settle their accounts as early as possible, ensure that you introduce the discount for them, right? So you are encouraging people to pay early. And again, you can still introduce the interest for late payments, like charge interest for late payment. That is targeted to discourage these people from delaying to settle their accounts. Okay. The target is to ensure that these people settle their accounts as early as possible. For that very reason, you have to introduce interest so that you discourage them from holding on to your money. Is that right?
Yes.
Okay, now let's see what happens. On example number 2, the same person, right? The same person's financial year now ends at 1st December. During the year ended 31st December 2024, he wrote off bad debt totaling to 950. This is bad debt that has been written off. Remember how you write this in the bad debt account? Debit the account, you credit the income statement. That's what I've said. Now, on 31st December, his trade receivables amounted to $25,000. So he decided to create a provision for doubt of debt of 4% of the trade receivables. Now pay attention to this. The question is saying that on 31st December, his trade receivables amounted to $25,000. So he decided to create a provision for doubt of debt of 4%. Out of this total amount, pay attention, out of $25,000, how much goes for bad debt? The provision for bad debt is 4% of this amount. Multiply this by 4%, which is 0.04. it would give us the amount that goes for bad debt. How much goes for bad debt? How much goes for the provision for doubted debt or the allowance for receivables? How much?
Pardon?
How much is it? What's the 4% of 25,000? What's the 4% of $25,000?
So what was the question? It was breaking just now.
Now I'm asking you that the question reads that the total amount receivables, right? The amount that you're expecting from your debtors is the 25,000. Out of this amount, 4% is what? Is a provision for doubted debt. So we want the 4% of 25,000. How much is that? What is the 4% of $25,000?
One.
It's one. One what?
$1.
Sorry?
$1, sir.
$1. I mean, 4% of $25,000. It can be $1. How true is that?
Oh,
25,000.
Sorry. I didn't put the extra 3 zeros. Sorry.
So what does $1,000? Okay. So now write up the bad debts account and the provisions for doubted debts of his account. Yeah. For the year ended 31st December 2024. This is just the same thing that we did in the previous example. You are to show the entries in the bad debt account and in the provision for doubted debt account. Let me show you how we do that. Of course, before we do that, afterwards, we'll show you how to prepare the relevant extract for the income statement. We need an extract for the income statement. We call it an extract because you will not be able to write, the whole income statement because you don't have all the information required. You just have part of the information. For that reason, we just write an extract. And of course, we'll show the extract of the balance sheet, the statement of financial position. So what happens? Okay. How do you show this in the bad debt account? So in the bad debt account, how do you show that amount in the bad debt account? We're supposed to indicate that we have. Hello?
Yes.
Yeah. Okay. So how much bad debt was written off? We have to show in the bad debt account. The bad debt that was written off was 950, isn't it? That's what the question says. So I told you that when you're recording the bad debt account, you debit the bad debt account, right? With the same bad debt that was written off. So the data is written off. The amount is starting to $950. Then you have to balance off the account. As you balance it off, the details that you write on the credit side, the income statement, showing that the income statement is being debited or is receiving the bad debt, because bad debt is it's an expense. So that's why you record on the credit side the income statement. The income statement, yeah. Okay.
Yes.
Yeah, so sure, now you are no longer having problems with how to record these in the bad debt account, the provision for bad debt account, in the bad debt recovered account. That's what I just said previously, how you indicate. So you have to pay attention. So now, how do you show these entries in the provision for doubted debt account, which is also called the allowance for receivables account? How do you show that? Okay. So now we have already said that the total amount that is going for bad debt is how much? It's $1,000. It's $1,000, isn't it?
Yes.
$1,000. Yeah. So that's the amount that you're going to write off here. Then you credit the provisions for doubtful debt account. Why do we credit? Because the provision for doubtful debt is an expense to us in the business. So if it is an expense, we know that when you go in the income statement, it's debited. I have been saying this again and again that in the income statement, the expenses are all debited, right? All of them, you debit them. Okay, so you have the income statement being debited here with the $1,000. Okay, so this is how you did, and whenever you have the provision for doubtful debt, whatever amount it is, just credit the income, the what's this, the provision for doubtful debt account is credited. Of course, the details you indicate the income statement of that year. You balance off the year, like you close the account, because we write these accounts every year. If you have a period of about, let's say, 5 years, you cannot say you record all the information on one account, right? One joint account. You don't do that, because we calculate the bad debt, the provision for bad debt every year. We do that every year. Remember, one of the principles that we follow in business is that the business has to exist for a foreseeable future, right? It has to exist for a foreseeable future. You can't just leave it open-ended. You don't know when to close. So that's why you always have the business usually exists for a period of 12 months. Like you look at it, after 12 months, you close the account, then you start again, instead of just leaving it open-ended. So it's a principle that you have to look at the business, and you should be able to see it for a foreseeable future, actually. Okay.
Okay.
All right. So now, how do you show an extract of the income statement? This is very important, and you have to expect this at during the end of term. How to record, and please pay attention now. Okay, how do you show this? We have already shown that in the income statement, the bad debt and the provision for doubtful debt, they are expenses, isn't it? They're expenses. So what you just do, you just indicate expenses, and under expenses, you write them. The bad debt, how much was bad debt for that particular year, for 2024? 950, right? Then 2024, we had provision for doubtful debt, $1,000 as well. Okay. Just show that they're expenses, and we know that in the income statement, all expenses are debited. So there's no need of trying to maybe show the whole account, the debit side and the credit side of the income statement. You don't do that. Instead, you can just show an extract, just the part, the part of the income statement where the expenses sit. Where do you find the expenses? You find them on the debit side. We already know that. So just indicate like that. Then now, when you go to the balance sheet or the statement of financial position, as it is called now, we know that the trade receivables, they fall under the current assets, right? We have them. They are current assets. So you indicate that current assets, this is where you can have this. Trade receivables, the total amount that we're expecting from our clients, and then you less the provision for doubtful debt, which is 1,000. So what remains is 24,000 as the value of current assets, and that is an extract from the balance sheet. Very easy, right? For this particular year, only for 2024. So if you had again for 2025, you would have done the same. So the accumulative provision for doubtful debt, you subtract it from the trade receivables, and then the difference is what you write. Okay?
Okay.
All right. So now, so basically, this is what what happens. You have to pay attention to this and follow through again and again. Yeah. Sometimes you can have the provision for doubtful debt increasing. How do you make entries? Let me just show you a scenario where the provision for doubtful debt increases from the previous period. Remember that in 2024, the provision for doubtful debt was 1,000, right? That's what we just wrote, that the provision for doubtful debt was 1,000. Now, during the year ended 31st December 2025, okay, this person writes off bad debt totaling to $990. Are you seeing what's happening in the question? So this is what has happened in 2025. The person has written off the debt of $990. What do you do? So, and again, the further information or additional information, it said that the trade receivables is amounting to how much? Have you seen that trade receivables have increased? 28,000. So he decides to maintain the provision for that debt being 4%, right? Yeah. Can you write up the bad debt and the provision for doubtful debt? We just write the bad debt account. How do you write the bad debt account? I said you debit the bad debt account with the receivables, isn't it? Yes. You debit the bad debt account, the debt is written off, and then you balance off the account. Of course, on the credit side, you show the income statement. I think this is what I have been saying again and again from the time we started this conversation. Now, look at the provision for doubtful debt account. How do we show? Remember, the provision for doubtful debt is now increasing. Okay, it was 1,000 last year in 2024. Let's see what happens. What is 4% of 28,000? You have to calculate 4% of 28,000.
1,120.
1,120. So have you seen that the provision for doubtful debt has increased, right? In the other year. Yeah. So what you do, you show how you show it. You start with we're just showing for 2025 course. So this in 2020, say 2024, start from 2024. In 2024, we credited a provision for doubtful debt account with how much? With 1,000, isn't it? That's 2024.
Yes.
And then after writing it off, writing like that, we balance off the account.
Yes.
Okay. So now in 2025, this is what is happening. In 2025, again, what is happening in 2025? We're having the bad debt, the provision for doubtful debt. The total amount is 1,120. Then we have to deduct the 1,000 from the previous year. You get it, right? Deduct a 1,000 from the previous year. So what you just have is 120. So we're just interested in the provision for doubtful that has occurred in the period under concern. We're just looking at the bad debt that has just occurred during this year, during 2025. We're not interested in the bad debt that occurred in 2024, which is the previous period. But we want the one that occurred in 2025, the year under concern. So we deduct 1,000 from what? From the total from total provision for doubtful debt. And so we just have the difference of 120. So this 120 is the one that we record as in the income statement for the year 2025. You're following?
Yes.
Yeah. So again, if for example, we had, let's say 2026 again, the other year, or 2027, like many years. So you could have again calculated the total provision for doubtful debt. Let's maybe have it at 1,500. Okay. Then we could have deducted we could have deducted 1,120 for the other year. You get it, right? We are just deducting for the previous years and just get the provision for bad debt that has occurred, during the period under concern. Okay. So after that, what do? Then you balance off the account, right? Since you're just dealing with 2 years, so you've recorded in the provision for doubted debt account all these 2 years. So you just balance off the account, and obviously balancing off the account does not give you any problem. So you sum up both sides on the credit and debit side, and then the balance carried down was on the credit or on the debit side, as I'm showing you here. And since the balance carried down is on the debit side, it means that the balance brought down shall be where? Shall be on the credit side, the opposite side. And you write the balance brought down with the first day of the next year. So the next year will be 2026. So 2026 is January. And you write as the details of the balance brought down. Okay, so this is how you deal with the account. It's very easy, right?
Yes.
Yeah. This is for when the provisions for doubtful debts are increasing. So you can keep on recording, but I've indicated that you just record the increase only. That's what you're interested in. What about the times when you are dealing with, obviously now showing this in the provision for doubtful debt account, you just record only the doubtful debt account, so you don't suffer, don't pressure. There are those times when when the bad debt reduces, right? When the bad debt reduces, the bad debt, instead of increasing, reduces. If it reduces, the reduction in the allowance for receivables or the provision for doubtful debt is an income to you, right? Is an income to you. So instead of recording it, instead of crediting the provision for doubtful debt account, you debit the provision for doubtful debt account so that you can credit the income statement. Why do you credit the income statement? In the income statement, we credit all the what? We credit all the gains, right? All the gains are credited. All liabilities are credited. All total equity section is credited and capital there. So those are the rules that we established when we were looking at the trial balance those days, right? Yeah, so just have to understand, you do the opposite entry and then you should be fine. Do you have any questions?